So I asked you to come on this series because I wanted to talk about one of the big themes in investing, the difference between growth and value. Let's start with a history lesson. Over the last 10 or 12 years, value has underperformed growth by some measures by the worst ever.
That's correct, by most measures.
Why? What happened in the last 10 or 12 years that we didn't see? Because I believe the University of Chicago's security database goes back to 1926, so we've got nearly 100 years of data. Why in the last 10 years has value stocks, the value approach, been such a poor performer when it never had in the previous 80 years?
Part of it is probably Fed accommodation, and a large chunk of it is narrative, that the marketplace embraces the notion that tech provides the new nirvana and that tech companies will dominate the world. Of course, they're brilliant disruptors, but disruptors get disrupted, and people forget that. The big issue and the really interesting part is that value relative to growth has gotten cheaper and cheaper and cheaper by any measure, price to book, price to sales, price earnings, you name it, and has gotten cheaper by a wider margin than its underperformance. So to be specific, if you use the classic Fama French from 2007 to the last summer of 2020, value underperformed growth by 5,800 basis points. Huge. But it got cheaper relative to growth by 7,000 basis points, even bigger, which means that if it was priced the same as it was in 2007 relative to growth, that value would have beat growth, which also means that the underlying fundamentals of value were getting better relative to growth. And so the value effect is alive and well.
Let's talk about value and growth. When we refer to that, I think people want to say, okay, what is a value stock? What is a growth stock? What are the metrics that we use to say which one is which?
Well, firstly, the classic is Fama French. And what they do is they say, here's 30% of the market that's trading cheapest on price to book value. That's value. Here's 30% that's trading richest on price to book value. That's growth. Everything in between is irrelevant. Let's do the same thing with small cap. And then inexplicably, let's equal weight those. So you wind up with this weird value portfolio that's half large, half small. Cheapest 30% on price to book value in both categories. Same thing for growth on the other side. Then you track the performance of the two portfolios. That's the measure of the value factor return. Now, when you go through that kind of exercise, what you find is that value has beat growth by pretty large margins. We take it back to mid-1963. Portfolios rebalanced once a year to make sure growth stays growth and value stays value. If your grandfather bought the Fama French value portfolio and his next door neighbor bought the Fama French growth portfolio, you would have inherited a portfolio that today is worth 4.5 times as much as the descendants of the next door neighbor. So value has beat growth 4.5-fold in the space of not quite 60 years. That's terrific, except that if you just stopped and indexed the portfolio in 2007, you'd be 10 times as wealthy. So value has underperformed in a huge way. That's the classic definition of value. If you use price earnings ratios, the peak in performance wasn't 2007, it was 2013. If you use price to sales, it's 2017. In other words, you hit new highs in 2013, 14, and 17, and then you had a meltdown in value. If you use price to book but adjust it for intangibles, and we can come back to this if you like, if you adjust it for intangibles, because book value is a terrible measure of the resources of a company when it comes to a services economy. If you use price to book adjusted for intangibles, the peak was 2014. So different measures of what constitutes value create different trajectories of return. Our preferred approach is to use a blend. Price to book adjusted for intangibles, price to sales adjusted for debt equity ratios, price to cash flow, price to dividends plus buybacks. So basically, how much does the company sell? The portion of the sales that aren't being used to service debt. How much does the company make on that? How much does the company redistribute out to shareholders through dividends and buybacks? And how much does the book value, the aggregate resources of the business, grow over time? Using the four measures, you get a blended view of growth stocks are the expensive ones, value stocks are the cheap ones. And using that, instead of 4.5 times as wealthy, you'd be 9 times as wealthy. It's about twice as powerful over the last 60 years.
So a lot of people that are listening to this and are hearing about these metrics and stuff, you have a website where they can go and look at all this stuff, and so they don't have to furiously take notes and try and recreate it. So point them in the right direction if they're interested in this.
If they Google Smart Beta Interactive, and the first link that's not an ad will take them straight to Research Affiliates website, to an interactive tool that's free. Classic pricing on the internet is free. That gives them tools for looking at value, looking at growth, looking at quality, looking at low volatility as a popular factor, looking at about 20 different factors and about 20 different so-called smart beta strategies that use various mechanistic approaches to choose portfolios. It shows how they performed over time. It shows how cheap they are today relative to history. It shows a forecast of forward-looking 5-year expectations of return for the strategy based on, is it trading cheap or rich relative to history? And there's a sister web tool that we created that's Asset Allocation Interactive, that looks at the relative attractiveness of 130 different asset classes around the world and allows you to create model portfolios and ask the question, based on current relative valuation, what kind of a real return can I expect on this portfolio? By the way, a couple of years ago, we had a challenge inviting users of that website to try to create a portfolio that would produce a 5% real return. I think there were 80 out of 40,000 who managed to do it.
At least you got 80 of them to do it. That's a high hurdle. So good. So listeners to this, you have a resource that they can go and take a look at. And as you said, it's a free resource and they can kind of play around with it. Let me go back to value and growth. Most people tend to think value is financials and energy and growth is technology. Is that always been the case when it comes to value and growth, that technology's always been in the growth bucket and values and energy and financials have always been in the value bucket?
That's a naive misconception. What constitutes growth is whatever is popular, trendy, and priced at a premium level. Whatever is in value is whatever is out of favor, unloved, and cheap. And that changes. Over the last 15 years, financials have almost always been on the value side. Energy has almost always been on the value side. Peak of the energy bubble in 1980, it was on the growth side. Technology in the mid-90s wasn't on either side. It was kind of in the middle, neutral. The only sector that has always been on the growth side is healthcare.